In this video, I want to show you a formula that'll help you prepare the statement of cash flows. And it'll be particularly useful if you're using the indirect method to make the statement of cash flows, which is the most common method that is used. Okay, so if we start with our fundamental accounting equation where we have assets equal to liabilities plus stockholders' equity, we can make a few tweaks to this to be really helpful when we put together a statement of cash flow. For example, we could note that assets could really be divided into two parts. You could have cash, which is obviously an asset, and then non-cash assets. So I haven't changed anything to this equation except I separated the left-hand side into cash and non-cash assets. Now we could also notice that if we take this equation and we were to look at the change in the left-hand side compared to the change in the right-hand side, if we just look at the changes, so change in cash plus change in non-cash assets, that would be equal to the change in liabilities plus the change in stockholders' equity, right? If you think about it, if this side must be equal to this side, and then this side goes up by $100, this side must go up by $100, and so forth, okay? So I've just changed it now. We're looking at changes in each account. Now, final step is if we were to say, okay, now let's subtract, let's take this non-cash assets, the change in non-cash assets, let's subtract it from the left-hand side, and then so now we would have it on the right-hand side, where we'd have change in liabilities minus change in non-cash assets plus change in stockholders' equity. So if we number this, so we've got our fundamental accounting equation, then part 2, then 3, then 4. The only thing different between parts 3 and part 4, or equation 3 and 4, is that we have subtracted change in non-cash assets from each side. So now our left-hand side of the equation is just change in cash. So all we're doing is saying, okay, how do we decompose this change in cash? How could we figure it out? And we say, okay, it's really this. It's a change in liabilities. So change in liabilities minus the change in non-cash assets plus stockholders' equity. If you're thinking, hey, Michael, how does this help me put together a statement of cash flow? Don't worry, I'm going to show you. So it's pretty cool. If you were to think about pretty much any account, so let's just take a liability account. Let's take unearned revenue. So if I gave you two balance sheets, I gave you comparative balance sheets, and I showed you that the unearned revenue account had increased by $125 from the prior balance sheet date, right? So there's been an increase of $125, and you're trying to figure out, hey, when I'm putting together the operating section of statement of cash flow, how do I subtract the $125? Do I add it, and so forth, right? So it went up $125. So what you do is you say, okay, unearned revenue is a liability. So if there's a change in a liability, there's an increase in a liability, it'll be an increase in cash. Okay, so it'll be added to the cash. So in this case, it would be added to cash flow from operations, unearned revenue. Let's take wages payable, right? And let's say wages payable went up by $50. Well, that's a change in a liability. So an increase in this liability is going to be an increase in cash. So if we take accounts payable, another liability, any liability, so the liability goes up, change in cash goes up. Now, notice with non-cash assets, things like accounts receivable or inventory, we see that non-cash assets are subtracted on this side, okay? So while liabilities, if a liability goes up, we add that to cash in terms of the operating section. We add it to the operating section as an adjustment. With non-cash assets, it's the opposite, all because of this minus sign, okay? Because of that minus sign, it's going to work exactly the opposite way. So if we find that account receivable went up by $125, then in the operating section of our statement of cash flow, we're actually going to subtract. We're going to subtract $125 for the change in account receivable. So we're going to subtract it because it's going to work the opposite way. If account receivable goes up, if inventory, let's say inventory went up by $75, then we're going to subtract inventory of $75 for the change in inventory on the operating section of the statement of cash flows. All because of that minus sign. So think about it. Liability account goes up, that's going to be adjustment added to cash. And now if a non-cash asset goes up, then it's actually going to go down. So if receivables go up, then we're actually going to decrease that when we're making adjustments to net income in the operating section of the statement of cash flows. Now, Not all accounts can be done like this, right? So if we think, for example, of retained earnings, with retained earnings, you can't just say, oh, retained earnings is a stockholders' equity account, so therefore if it went up, then we just say, oh, increase in retained earnings, and it doesn't work like that, and here's why. So retained earnings is affected by two things. It's affected by net income or net loss if you have a net loss. So it's affected by that, and it's affected by dividends that are issued. There are other things that can affect retained earnings, accounting changes, and so forth. But these are the main things, right, for like a basic accounting class. So we already know from the income statement, or if you're working a statement of cash flow problem, you're probably going to be given the net income or net loss, okay? So we can't just take the change of retained earnings and just dump that in a statement of cash flow, because then we'd be double counting the net income or net loss. So we start with the net income or net loss at the top of the statement of cash flows. And then we would have the dividends paid. That would be in the cash flow from financing activities. So we're not even going to have an account that says change in retained earnings in the statement of cash flows. So this is not going to work when we use this formula. But this formula is helpful for things like, let's say you had, increase in deferred tax liability. So the deferred tax liability went up by $200, and you're thinking, oh, what does that mean? When you're making the operating section of the statement of cash flow, do you add this? Do you subtract it? Maybe you're not even sure what a deferred tax liability is. But you say, okay, look, it's a liability, so it goes up, and so that's going to be an addition. We're going to add that back as an adjustment when we're making the operating section. And what I mean when an adjustment, I say, and watch the video on statement of cash flows if this is kind of foreign idea to you. But we start with net income or net loss, and then we make these adjustments, right? We make the adjustments. We say, oh, okay, we're going to add $200 because there was a change in deferred tax liability. Deferred tax liability went up, and then there's a change in account payable, and so we make all these adjustments, and we get to cash flow from operating activities, and then we have cash flow from investing activities, cash flow from finance activities, and so forth. Okay, but so this formula is not going to help you for every single account. But when you're thinking about these accounts, these accrual accounts like account payable, wages payable, unearned revenue, these types of things, this formula could be really, really helpful to you in making the statement of cash flows.